welcome everyone, and to another one of our Q&A events, and welcome also to our 100 plus strong online audience shooting at home. We did have the room fully booked, but obviously the weather, looking at the name badges still sitting on that table out there, the weather's played a bit of havoc with the traffic and people's driving ability, I believe. For those of you in attendance for the first time, I just reassure you it's not a sales conference. However, it would be remiss of me not to mention that we're nicely holding this event across the road from our fantastic new offices that we moved into in October last year. It's a move that's reflective of our growth, having huge growth in funds under management and a national land pipeline now in excess of 2,000 residential lots with an on-completion value of over $1 billion. But our goal through these events is to provide additional value to our investors and business partners, basically through opportunities like this for informative or information or education on a topic that we find relevant to what we do or relevant to what's going on in our investors and our partners' lives. We've had demographers, we've had SMSF experts, financial advisors, and a range of different speakers, all bringing different insights to these sessions. I'll now introduce our speaker tonight, Colin Keane. It's the second time he's presented at one of our Q&A events, having done so in Melbourne a few years ago. So he was so informative, we thought we might let him have another go. He's been in the residential property research game for 20 years now, and probably most notably, he's responsible for delivering the National Land Survey or the Greenfield Market Survey. And for industry professionals like us as developers, this is the most reliable and widely used data in property circles, owing to its consistent accuracy and detail year after year. And by my estimation, I think it must be about its 20th year this year. I think it started in about 2005. Also, just a note, if you do have questions, Colin will repeat the question, and that's just so the online audience understands what the question was. So if you're wondering why he repeats the question you ask him, that's just so the online audience knows what the question was. So thanks, Colin. I'll welcome you now. And I'll put that down there so remind me of my wife. Thank you for inviting me to tonight. It's good to be here. What we're going to do today is talk about the greenfield market. So it's a land market. And as already stated, Research 4 monitor the performance of the land market around the country, including WA, Southeast Queensland, Sydney, Canberra, Adelaide, Melbourne and Geelong. We've been doing that since 2005, nationally since 2008. And it's the longest running survey. It drives us a little bit batty every now and then. But so today we'll be looking at the results from the survey up until December 2024. That's a disclaimer. So it's weird. What I want to do from the beginning is to just give you an overview of the national greenfield market. So we're going to focus on Queensland tonight, but it's always very helpful to know where Queensland sits relative to the other major markets, because it gives you a better understanding as to the market cycle and where everything's going. At the moment, it's a bit of a juggle, the national greenfield market. You have markets which are doing really, really well, and markets which are struggling, markets which are on the rise, markets which are on period of correction. If you looked at all the markets around the country and you added up all the land that is sold each month, that's the blue line. And what we're looking at in December is that the national market sold 3,000 blocks of land per month. So that's what Land Estates did around all the 5 major capital cities for the December quarter. You can see back in COVID that the market sold around about 7,000 lots per month. And so COVID was a very good thing for the property market. And one of the reasons why it was a very good thing for the property market is because 680,000 Australians came back from overseas where they were living, and they decided to come back home. And what do you do when you get back to Australia and you've got nothing to do? You buy houses. So that's what they did during COVID. We are now into the fourth market cycle. So since 2008, there's been 3 up and downs, as you can see by the grey areas. And we're now into our fourth market cycle. In terms of Melbourne, this is a picture of the Melbourne land market at the moment. So the Melbourne land market is the guy and the government is the backpack. So we have a few kind of clear problems in Melbourne with trying to lighten the backpack. But Melbourne is expecting to actually experience some sort of improvement in the second half of 2025. You can see here, this is a common graph here of Melbourne. Melbourne is land sales in the blue. And the orange, which I call a yellow brick road, is basically what the market should be selling according to population demand. So if it's just a yardstick, but its demand is the yellow line and the blue bars are land sales. So you can see that land sales in Melbourne have been under the yellow brick line. In other words, they've been underselling. And the reason why they've been underselling primarily is because during COVID, you can see the blue bars going well above the yellow brick road. So we were actually selling or bringing forward customers into the market early. So we were overselling. And because we were overselling for the last 2 years, we've been underselling. And now we've got to that point where it's break even. So we're expecting some sort of improvement, a very modest improvement, but some signs of recovery the first half of 2025 and then maybe strengthening in the second half of 2025. The main issue on the other graph is the Melbourne house price has been going down. And one of the reasons why the Melbourne house price has been going down, this is ABS data, not CoreLogic. The reason why it's been going down is because of the tax regimes, I think, which the government has been placing on investors in that state, land tax and disincentives for investors to actually get in the market. So as a result, rental product has been put onto the resale market, which has lowered the price point and increased the volume. But land has actually gone up because of the cost. In terms of Sydney, it pays not to look down when it comes to pricing. So just keep your head there. But somehow the market operates. The market is actually operating in line with the yellow brick road. In other words, it's doing what we thought it would do according to population change. Population change is net interstate migration, natural population, net overseas migration, etc. Sydney in the December quarter broke off a little bit, but actually it's heading in the right direction. But you can see in terms of pricing, it's $680,000 for a block of land, which includes the Hunter and the Illawarra regions. If it was just the northwest Sydney, you're probably looking at $800,000 for a block of land. But land prices can only keep going up if that blue line keeps going up. So it's very tight. It's a tight relationship in Sydney around affordability. And there's not a lot of supply in Sydney, which puts upward pressure on pricing, but the customers do have a budget. In terms of Adelaide, the important thing about the Adelaide market, if anyone's in it, is to be very aware of that child on the windscreen. The unexpected is what's going to happen in Adelaide. And the unexpected at the moment is net interstate migration has gone negative in Adelaide. So Adelaide is actually losing population growth at the moment. It's gone back to pre-COVID levels. But also at the same time, they've run out of pipes to put sewage in the ground. So the government has actually run out of water pipes. So that's also helping land sales go down. And as you can see there, land sales have been going down. And we expect them to actually moderate a little bit further for the next, maybe 24 months before stabilising. But in terms of values, it's been very profitable in Adelaide over the past 2 years, incredibly notable rise. You can see the black line is land prices. And land prices are at $335,000, which is a bargain compared to Logan or Ipswich, for example. But once again, land prices go up only because house prices go up. In terms of Perth, from a snapshot, Perth reminds me of a 21st party or an 18th birthday party. It's been going now since 6 o'clock in the afternoon, and it's about 12 o'clock at night. And these are the last ones. They should be going home. So it's getting late, and it's time that the Perth market actually moderated. So we're expecting the demand in WA to keep moderating over 2025, despite land sales coming back towards our yellow line. And the reason why they're very high is because they were underselling during COVID and they had unmet demand. So that unmet demand fueled the last 2 years of strong sales volumes. The other thing is house prices and land prices. Once again, an incredible roller coaster up in terms of values for land in WA, and they are very well priced at 365. So even though they've gone up a lot compared to Sydney or compared to Queensland or Melbourne, they're a very attractive product at the moment. But WA goes up and down like a yo-yo. Queensland, this is you now. The thing that came to mind is a fighter jet pilot going up and up and up. And I think it's time now that the market leveled out. So my position on the Southeast Queensland market, it's been the number one market in the country for the last 2 years. Now, WA has been equal 1 or 2. If you looked at land sales here in the blue, they're as high as WA. So they got up to 1,000 per month, maybe in the September quarter, 2024. The rise in land sales, the rapid rise from 2023 through to 2024 has been incredible. It's been a faster rise in land sale volumes than it has in COVID or in the post-GFC correction in 2012. In terms of land sales, in the December quarter, the market sold 856 blocks of land per month. Over the past year, the average has been about 900 lots per month. Now, remember, I'll put that into perspective. Melbourne is doing 550 lots per month. Queensland is doing Southeast Queensland is doing 900 per month. So it's virtually, for argument's sake, double 40% higher than Melbourne at the moment. Now, that's generally unheard of when Melbourne normally does 1,600 to 3,200 per month. Putting it in another way, the blue bars represent land sales again, which I just showed you for Southeast Queensland, and the black line represents cancellation rate, or another word is confidence. So the lower the number, in other words, 4% of all land sales at the moment are being given back to developers. So if a developer sold 100 blocks of land, next month they would get 4%. Now, that's a very high level of confidence. I know it's an inverse relationship, but 4% means very high. Virtually nothing is being handed back. Anything above 15% indicates that the builders or the mums and dads who are buying those products are becoming uncertain. And you can see back in 2023 when land sale volumes were at a rock bottom in Queensland after COVID, the cancellation rate was 32%. So generally a high cancellation rate correlates with a drop in land sale volumes. But you can see the confidence in SEQ is incredibly strong at the moment. Everyone who gets a block of land generally wants to keep that block of land. They're not giving it back for any reason. Once again, if I use Melbourne as an example, for the past year, the cancellation rate has been 22 to 25%. So for every 100 blocks of land sold, 25 of them are given back each month. That's a bit of a problem, and until that cancellation rate comes down, which it will come down, because they always do, land sale volumes will continue to struggle a bit. And in terms of cancellation rate around the sub-markets, so in Queensland you've got Sunshine Coast, Brisbane, Moreton Bay, Brisbane, Ipswich, Logan, Gold Coast, and Redland, if you want to talk about Redland. Every one of those has a very good or very low cancellation rate. Probably the worst one would be, I think I'll talk about, is the highest one is 9%. In terms of stock, so once again, what you're looking at here is land sale volumes in the blue, lot sales per month for Southeast Queensland, and stock ready for sale. So how many blocks of land are on a price list? This is not supply in paddocks or zone land. This is how much is on a price list. So you go in and you get, well, what do you got for sale? I've got 26 blocks. This is what it's recording. So at the moment, there's around about 900 blocks of land on a price list around Southeast Queensland. And once again, that is very low for a market operating at current levels. It should be closer to where maybe that dot where I've said it should be here. And that's purely just using past history as a correlation. But the point being is that we're not seeing a build-up of stock. Therefore, we're not seeing developers producing stuff which is not wanted, which therefore is going to maintain upward pressure on pricing. And secondly, it's a reflection that demand is still strong and confidence from builders and mums and dads and investors is also very strong. So it's a positive sign there. Probably not for affordability though. Have you gone somewhere? Yep, good. I didn't think I was that bad. Okay. You're paranoid. Underlying demand for SEQ. Now we'll get into some boring stuff, but to kind of give you a sense of comfort, as it were, as to knowing if I know what I'm talking about. These are 5 graphs, and they're looking at land sales in the grey. So that's just land sales for Southeast Queensland again. And the blue bar is the population change for that type. I'll take you through each point. And there's a forecast. Now, what you're seeing in the blue line is used to generate how many blocks of land we need in Southeast Queensland per month going forward. But in terms of new residents, so housing demand, people who buy blocks of land or houses will come from population change. Population change will come from people coming into the country and being given citizenship. When they're given citizenship or residency, they're allowed to more freely buy their own block of land and house. If they don't have a residency, it's very hard for them to actually buy land. And as you can see here in the blue, the new residences have peaked and they are actually forecast to moderate. But that peaking of new residents is just purely a correction post-COVID because people couldn't come into the country. And once the boundaries were, or the borders were open, then they could come in. So you got this spike. But the federal government has increased the number of new residents, so to about 185,000 nationally. It is a major influence on the Queensland market, and as you can see, it will remain so going forward. Number B, residents, net overseas migration. This is citizens of Australia leaving the country for a long time and then coming back for a short time or whatever. And this was the major reason why we saw a spike in demand in land in Queensland during COVID, because like I said, there was 680,000. You can see the blue one in the middle. Spiking, that's people coming through the airport with their suitcases and then going straight out into the housing market. And you can see the strong correlation there between the grey line and the blue line. Students get the most airtime on the media or in the press. You know, they'll say we're in a housing crisis. And the reason why is because we've got 5 million people coming through the borders. It's a bit of an exaggeration. What they're confusing with, you can see the blue line in students. That's the change. In COVID, it disappeared. It went negative. The reason why it came back in a rush is when the borders opened, all the students came back in a hurry. That hurrying of students coming back into the market shocked the media more than anyone else. But you can see here that the actual volume of students in the market in Queensland is back to normal, stable levels. What that means is that impacts the rental market, not the home ownership market, because students rent in the inner city areas. But that issue of students coming back into the country is now gone. It's now stabilised. Number D, net interstate migration. This is a major one for the land market in Queensland, and you can see it's back to probably pre-COVID levels, which is still pretty high, and we're forecasting it to remain at current levels. You always look at net interstate migration as a good indicator as to whether the market's going up or down. And even though net interstate migration is down, it's still at a healthy level for Queensland, and Queensland has the strongest net interstate migration. It's taking people from Melbourne. I've lost half my family to this state in the past year. I think they were regretting it last week, I think, or on the Sunshine Coast. And the last one, that one, locals. So these are the people who live in the town, who actually grow up in the town, who enter into the housing market or exiting the housing market. So those ones who are going into retirement living or they're just dying, versus those people coming out of the house into the housing market. Now there's a gateway. The average people coming into the housing market are aged 25 to 33. That's 25, 33. Yeah. And people leaving the market are generally, obviously older. But what you can see in that blue line is that the demand from natural population dropped significantly. And that coincided, I'll let you guess what that coincided with, the change in the net, the birth and the death rate. And it hasn't improved. Yeah. So the local population is becoming a weaker source of future housing demand at the moment, and there's no sign that that will improve. But even though it's low, it's still 30% of total housing demand. So anyway, we're back to normal in terms of population drivers. So when you add all of those blue lines up, about 38% of total housing demand for southeast Queensland. So for every 100 homes that is needed in Brisbane and the surrounding areas, around about 40 of them they go into the greenfield market. 40 out of every 100 homes needed in southeast Queensland is addressed by land subdivisions, which is normal for most markets. In WA, it's 45%. In Melbourne, it's 39%. So when you do that, you get an underlying demand for southeast Queensland, which is a yellow line. And you can see here the blue bars are exceeding underlying demand for land. And the forecast is for demand to go up to about 862 lots per month by about the end of 2026. So land sales are at 900 at the moment, and arguably they could be lower. But there's a reason why they're higher, and it's because of this. I'm going to give you a lot of charts. This chart, I'm going to try this out. This chart here, where you see the blue bars underneath, that means that demand has gone unmet. They haven't sold enough housing. There's more customers are waiting. There's unmet demand. When you see the bars go above, that means that we're selling too much. We're bringing customers into the market early, and then it breaks even again, and then we're underselling. And this coincided with the rapid increase in land sales that we've seen over the past 2 years in Queensland, is because we were underselling. We could sell more than what we would normally do. But at the moment, we're around about break even. And if we continue to sell at around 900 per month, then we will keep bringing future customers into the market. So what I'm saying here is that we're expecting land sale or demand for land to moderate, not go down, but kind of moderate from this point forward. So before I go on to that, so with that in mind, we see that blue bar. If I can draw a forecast, the sales will go like this. I shouldn't say they will, they might go like this. I'll go this way, across here. So we're expecting some sort of moderation, not to go up, but to kind of move sideways, which would be a very good outcome. In terms of giving you a little bit of a snapshot on the individual markets very quickly, this is, I'll just explain one and then I can very quickly go over the other ones. This is the Ipswich market. So once again, you're seeing the blue bars which exceed the yellow bar. Yellow is what it should be selling. Blue is what it actually is selling. So it's sold about 173 sales per month for the last year, but that's still 7% below the 7-year average. So even though it's good, it's still below the long-running average. Demand forecast, it should be doing around about 128 lots and moving to about 170 lots. It's actually brought forward demand into the market. Therefore, we expect Ipswich in terms of sale volumes going forward to pretty much hold steady where it is and head flat. Not necessarily go down, but kind of move sideways. We don't expect land sale volumes to increase from where they are at the moment. In terms of Logan and Ipswich are the major markets, the big W of land markets in Queensland. So you've got Logan here, which has done exceptionally well. You'll notice that the blue bars on Logan are well above the yellow benchmark line. And the reason why Logan is doing exceptionally well is because the Gold Coast has nothing to offer. So when the Gold Coast used to have a good land supply, it kept Logan at a moderate level. Now Gold Coast has very minimal land supply. Therefore, more customers are going into the Logan market and punching it higher. We expect land sale volumes to actually kind of moderate there once again. And it's we'll talk about pricing in a minute, but that's Logan. Moreton Bay has done extremely well. Its land sales at the moment over the past year have been 226, which is 17% above the long-running average. The forecast is up to about 174 land sales per month. But Moreton Bay is getting more supply. It could potentially hold at those high volumes. It's a very attractive market. It all depends on the final price point that is being offered in Moreton Bay. But it's doing really well at the moment. In terms of the Sunshine Coast has basically 7 trading projects. Its main projects are Aura and Harmony. I always feel relaxed when I go there. I feel like I have to be. Anyway, land sale volumes in the blue are following along according to demand, but they have a real supply issue in the Sunshine Coast. They can't get enough land, and the pricing of that land is kind of also, which we'll get to in a minute. In terms of Brisbane, now this is the outer part of Brisbane, including the northern part, which are, and also around Rochdale as well, in the southern part of Brisbane. Once again, land sales over the past year have been 70. They've been in line with the yellow demand, so there's nothing out of the ordinary here. They haven't been overselling. They've been underselling by about 1.5 months. So there'll be upward pressure on pricing in a way. It's a small market, but forecast demand is between 70 to 90 blocks of land per month. And the Gold Coast, remember the Gold Coast cannot keep up with demand. So therefore, the blue bars are trailing the yellow line. They have been underselling by about 5 months, meaning that underselling has gone to Logan. That's my guess, which I think pretty much stacks up. Very quickly, selling capacity. This is quite important, the number of projects operating in Southeast Queensland. So the blue bars there represent number of projects. At the moment, there's 160 projects which are active across the Southeast Queensland greenfield market. You've got around 74 of those projects, 74, which are basically coming to an end. So the number of projects is 46% of all projects which are virtually at the end of their trading life. What does that mean? That means that Southeast Queensland need more projects to replace those projects which are ending. The fact is that the rate of replacement is much lower. It's 14% lower over the past year, and the size of the land estates are halved. So normally they're about, say, 450 lots, and now they're around about 220 lots. So the size of new land estates is smaller, and the number of replacement estates coming on is also smaller. This just gives you an idea of the maturity. So basically, around about 40%, I think. 40% of projects, large percentage of projects are fully released. So 90%, they've released 90% of their stock. In other words, they're coming to an end. I have to turn this on. This graph here actually is a great graph on working out when prices are going to go up and when they're going to go down. So this black line here is what all the land projects can actually sell. It's called their selling capacity. So if you added all those 160 projects up and you got their average sale rate, what they could do, you would get this line here. This is selling capacity. This blue line is what they've actually did sell, and this is the demand going forward. So the interesting thing here is when the blue line goes above the black line, you get upward pressure on pricing, upward pressure on pricing, upward pressure on pricing, downward pressure on pricing, downward pressure on pricing. So the issue here is that demand over the short term is likely to be around about this level, but it's not going to be sufficient to push prices up in any significant ways. So what we're going to see probably is a moderation in price growth across the land markets over the next year to two. But that could change. In terms of greenfield pricing for land is always connected to house prices. So the only reason why land prices go up, and this is a rule, a law of nature really, is because the Brisbane house price will go up. You can see Brisbane house prices are $925,000, and because they have been going up, it allows the land price to keep following up. House prices land prices are at $444,000. Will they go any further? It depends totally on whether that $925,000 house price will go higher. My guess is that it's unlikely to push too much higher. Melbourne's land house price is $850,000. Sydney's $1.4 million. Brisbane has got the second most expensive housing market in Australia at the moment, next to Sydney. So it's still $500,000 off Sydney, but will it go up? It has to slow down, I would say. In terms of who's driving the market, you've got existing home buyers who are selling their homes and buying an existing home. You've got first home buyers. You've got people buying a new home, and you've got investors. So what you have over here, this is the main one. You can see the number of people buying existing homes, and this orange line is the house value. All I want to see in point A is the escalation in the level of activity on first home buyers here. First home buyers go up. Loans and investors in the investor activity goes through the roof during COVID. And activity for brand new homes goes through the roof as well. The reason why house prices went up during COVID is because every one of these four customers for existing houses, customers for first-time buyers, customers for investors, and customers of new houses all operated at very high levels. And that was the reason why the orange line went from there to there. So all I want you to look at is what's happening in the current climate in the letter B. So the letter B is that investors have come back into the market, which has helped price growth. They've been the major ones operating over the past 2 years. First home buyers haven't really been spiking. They're kind of at a modest level. Loans for new dwellings is quite pre-COVID levels. And then loans for existing houses is not bad. So what you have at the moment in southeast Queensland is a market operating on people who are looking for existing property and investors looking to capitalise on a strong price growth in the market. But first home buyers are back to normal levels, and so you just got to be mindful of those moderating those customers which are moderating in activity. In terms of overvalued, land to house, southeast Queensland land is normally priced at 46% of the Brisbane house value. At the moment, that would mean that land would be about $427,000. So if you ask me what is the nice price point for land in southeast Queensland, it is $427,000 a block of land. That's taking the whole thing in. At the moment, it's $444,000. This is my last graph. Breather, sigh release. So I'll talk to it. So once again, it's just land. All I want to show you is the relationship between Ipswich land, which is $371,000, and the Brisbane house price. Logan, $375,000. So in terms of Ipswich is not overvalued. So its land at the moment is spot on. There's minimal risk. There's no overvaluation in it. In terms of the Logan market is technically undervalued. So instead of marginally undervalued, so it's 375, it could be around 379. So the sweet spot for the market in Logan is 379,000. In Ipswich, it's 369,000 for a block of land. Remember that sweet spots will change if the Brisbane house price goes up or down. In terms of Moreton Bay's price is $449,000. Now, it's a really difficult market because it's split between projects which are premium and projects which are more affordable or best valued. But it could potentially go as high as $483,000. So the Moreton Bay market has probably the most potential to actually see some sort of upward lift in pricing. But once again, that depends on which side of the highway you're on, I think. In terms of the Sunshine Coast, so the Sunshine Coast is $509,000 for a block of land. That's probably about 9% over fair value. It should be closer to around about $462,000. And that's from Noosa right down to, Harmony. So it takes in a lot of waterfront or premium property as well as, Aura's and Avid's property group as well. In terms of Brisbane, the current price is $760,000 for a block of land. That arguably is overvalued. It should be closer to $600,000 for a block of land. The reason why it's overvalued is because there's not a lot of demand, a lot of supply, a lot of projects operating, therefore the prices have been able to increase. But I would say that the Brisbane proper market is probably the more at risk of being overvalued over the short term. The Gold Coast has no land supply, $815,000 for a block of land. Arguably, it should be closer to $730,000. But once again, the reason why it is high is because there's no supply. You can look at these after as well. So that's the last slide. So I'll sum up. What I want to say is that basically Queensland has been the number one greenfield market for the last year and last 2 years actually. Queensland and Perth have held the mantle of selling around about 1,000 lots per month. Each market has been doing that. Queensland has benefited from a large inflow of people from Melbourne and Sydney due to affordability and COVID-related issues. It's been a very affordable market. It's been able to deliver housing to first home buyers when they need it. Going forward, there is no reason to think that the southeast Queensland market will experience any significant correction because I don't think there's any correction that needs to be made. But what I will think the SEQ Greenfield market will do over the next year is moderate. I don't think you'll see it go much higher. And what that means is that in patches around the market, you'll see possible upward pressure on prices and some markets with a little bit of downward pressure on pricing. But overall, the level of demand will remain pretty stable, which is a good thing. The interesting thing will be to see whether the first home buyers come into the market in a bigger way. But like I said, I think demand is stabilised now. Price growth is going to stabilise it, go back to a more modest kind of rate. And it's technically, you should wake up again, be comfortable. So thank you very much. So if you have any questions, happy to take it. If you don't, or you want to talk about them later, that's fine. It will have, so the question is, will the Olympic Games, will they impact the performance? Yep. Yeah, well, yeah. I think, I think the answer would be that it would have a positive impact on population movement in, but I don't think it'll have a notable impact on underlying housing demand, change that in any particular way. I think it'll have an impact on the rental market, which maybe the short-term rental market, because I think Queensland is now, it'll attract maybe skilled labour from the south, for example. But the problem is that Queensland does have a reputation now of being very difficult to actually get a home. So it might be a harder job to attract trades in compared to, say, 2 years ago. But yeah, I think it'll impact the rental market more significantly. Yeah. In terms of volumes or sales? Yeah. So the question is, what is the impact on the performance of the market if the lending rates go down? Short answer is that it would be positive, that it would enhance or give the make affordability a little bit easier. It could allow prices to go up. One of the reasons why prices have gone up in Queensland is because the amount of money individuals have added to their loan, so their equity in the purchase price, has actually been increasing. And that because of low interest rates, but also because that capital has come from Melbourne property market and Sydney property market. So people who are moving up from Melbourne or Sydney have, obviously cashed in a higher asset value. Yeah. Yeah. So we've seen a notable increase in the percentage of equity that each customer is adding, which has pushed the price up. Now, the issue is that the interest rates will allow people to have a little bit more equity. But once again, if there's limited supply or the capacity of projects to deliver is difficult, then that'll be just translated into price growth. I don't think it'll have much of an impact.
Spend like in paper, begin low support all that tell.
Yeah, that's right. So I think Logan and Ipswich are clearly the more affordable markets for Southeast Queensland. So they're going to be sensitive to any movement in lending rates. But the other big thing that we don't see in Queensland is lot sizing. Lot sizing is quite big compared to, like, for example, in Melbourne, I think 25% of all products sold in Melbourne is less than 250 square metres in size. But that gives you a price point. You can still raise a couple of head of cow on that. You go, a trampoline, swimming pool, the whole lot. That's nothing. I just bought a house in Sydney. It's got 114 square metres. Yeah. It's got 2 kids on it. Yeah, that's a house. That's a terrace house. But the other thing is that the lot sizing hasn't been really exploited in Queensland, like in Melbourne, to lower the price point for affordability. They just issue more 250 square metre blocks. Yeah. So, yeah, that's another issue. All good? All right. Well, thank you very much. And I'll hand over to...
Thanks, Colin. Couple of takeaways there. We do love what we call a normal market. There's nothing wrong with that. Especially for us, we bought most of our sites 2 to 3 years ago. So that growth has been happening while we wait to get started. But yeah, a lot of media speakers and presenters, it's always boom, bust, boom, bust. There's nothing wrong with a moderate or a normal market. We quite like them. So to the Olympic stuff, one thing that I think we'll get out of the Olympics is finally some infrastructure growth. The government haven't been spending much on infrastructure for a long time, so hopefully with the Olympics they'll finally upgrade a few roads, let us get around town a bit easier, so that should help us, and maybe we'll find out where the stadium is built in about 2030. Cash rate, I think, whether it has an upward impact on prices, probably just grows the market at least. People that right now can't afford something, every time the cash rate lowers, there's more people come into the market as opposed to driving the price up. And I think if you've got a couple of cows on 250 square metres, they're probably in the freezer. So on that note, I think we'll move on to dinner.